we'll go right into it. So in 2017, end of December, Trump signed into law the Tax Cuts and Job Act, and basically it starts and it's effective for 2018 and future years after that. The importance to most tax filers is that the new tax law alters federal income tax brackets, doubles standard deductions, and changes many other tax credits and deductions. This slide shows basically a synopsis of the 20 or so areas that changes were made. Today we're going to talk about how they affect you as a CTA, IB, or a CPO, or a hedge fund manager. So I'll just pick out a couple of those and we'll go forward. Let's start with something fun, alimony. So the old rule is that you paid alimony and you're able to deduct it. And then the person who received it had to claim it as income. The new rule, starting 1/1/19, states that the individual paying the alimony cannot deduct the payment from their income, and the person receiving the payment does not include them as income as well. Corporate taxes. That's always that actually worked out really well for the stock market and a lot of investors. So in regards to corporate taxes, the old rule states that current top corporate tax rate is 35% on taxable income greater than $10 million. The new rule cuts the corporate rate to a flat 21%, right across the board. Big win for corporations, big win for cash flow, and hopefully it was reflected in the stock prices in 2018. Pass-through business. Another area where we see changes is in regard to pass-through businesses. Pass-through businesses are generally small businesses like yours that don't pay corporate tax. Instead, the owner reports the corporate profit as their own and pays taxes based on individual tax rates. Some of the common types of pass-through are LLCs, sole proprietorships, S-corps. The old rule made all pass-through business owners' income subject to regular personal income tax. Under the new rule, these owners can now deduct up to 20% of their qualified business income from a partnership, S-corp, or sole proprietor. Do not get too excited. This deduction does not relate to trading partnerships or LLCs. But Mike came to me earlier today and asked me if it relates to his IB. It does. So how it works is, if you're a trading partnership and you make your income off of capital gains, so this rule does not apply to you. You can't take the 20% deduction. But if you're an introducing broker and your income is based off of commissions, so you basically have ordinary income, then you get to make that deduction. So a lot of the accountants out there don't know that. They just think just because you're in the commodities or trading industry that you fall under that basically trading partnership or trading LLC, which is not the case. So I think I saved you a bunch of money today, didn't I, Mike? Okay, thanks. There's a phase out, meaning that the 20% deduction phase out is based on income. For example, individuals earning $157,000 or married couples earning $315,000 are eligible for the fullest deduction. So if you're making $1 million a year, you're probably not going to be able to capture that 20% phase out. Difference between the old and the new is there's still 7 tax brackets. The only difference is that the rates have changed for all the brackets. I'm just going to go to the next slide so you guys can see that. So single individuals, they went down. So the highest in 2017 was 39.6%. In 2018, it's anything over 500,000 is 37%. So the top tier have got a great tax savings from 2018 forward. This new tax bracket expires in year 2027. Miscellaneous tax deductions. This is a big deal for us in our industry. The first one, tax preparation, you pay me, in the past you're able to deduct that expense, now you can't. The second, work-related expenses, in the past, if you didn't get reimbursed for cars and parking or whatever the case may be, you were able to take that as an itemized deduction, and it was limited or past a 2% floor. But the last, investment fees, you were able to deduct that if you paid your CTA or your trading manager, and now you can't. So 2018, what does that mean? So if I gave money to a CTA and he made me $100,000 and I paid him $25,000 in fees, management fee and incentive fee, I have to pay tax on the $100,000 that I made. In the past, I paid tax on $100,000 less than $25,000 for fees that I paid him. So it's a big deal. And how does that relate into real life is that we have clients who are CTAs, and then when they're negotiating their fee structure this year, the smart investors basically came up with this and say, listen, I'm not paying you a 25% incentive fee because now my tax rate is so much higher. I might as well go invest in a fund where those expenses are actually written off by the fund and I get advantage of that. So the CTAs, some of them have taken a hit on their fees just to make the investors happy. I don't know if anybody experienced that in the room, but we've seen it multiple times this year. That leads us to, after investor fees, we'll talk about how investing in a fund, I guess the funds, if you invest in a fund, the expenses that are paid to the trading managers are tax deductible, their expenses. So that hasn't changed. So there is definitely a positive advantage by investing in a fund versus a managed account because of those expenses, which is could be substantial. Trader tax status is the next thing. What does the trader's tax status mean? There's a difference between an investor status and trader's tax status. So if you're a trader and this is how you make your income, you want to be able to qualify as a trader tax status because then you can write off all your expenses. So basically, if you are a trader in securities or futures, when you file a tax return with the IRS treats you as an investor by default. Being an investor, your income from trading is classified as either long-term or short-term capital gains. While long-term capital gains enjoy lower tax rates, this may not be ideal for your situation. As an investor versus trader tax status, you no longer are able to deduct all expenses incurred while trading. So that's a big deal. That means your home office, your computers, your screens, they're not deductible if you're an investor. And also too is that all trading losses incurred can only be deductible against your ordinary income up to $3,000. Lastly, if you're an investor versus trader tax status, is that the wash sale rule applies. The wash sale rule prevents you from claiming a loss on a sale of stock if you buy replacement stock within 30 days before or after the sale. So there's some limitations, and the biggest change is now you just can't write off all those expenses that you had as an investor. But if you can qualify for trader status and then make an election to mark-to-market accounting with the IRS, all your losses from trading become ordinary losses for tax purposes. And this avoids the applicability of the $3,000 rule. And also eliminates the since you're mark-to-market, you don't have any wash sale problems. How do you qualify? It's kind of tough. If you're a trader, there's an IRS publication 550 for more details, but this screen basically goes through some of the things that you need to be able to show the IRS that you qualify. Basically comes to frequency. Is this your main job? Are you trading more than 75% of the time? Volume, at least 720 trades per year, millions of dollars in equity, etc. Once you qualify for trader status, you then can make a Section 475F election, which 475 election is basically mark-to-market. Now, what does that mean? That means that if we make this election, you no longer have capital gains losses. It's all ordinary. So it works if you have losses that are greater than $3,000 because all that loss can be written off against your other income or your wife's income if you're doing a joint return, and you can deduct that from your ordinary. The disadvantage is that if you make the election, you lose your long-term capital gain portion of your trades for your 1256 contracts. So your long-term capital gains are taxed at the high rate of 20%, where your ordinary income is taxed, could be as high as 37%. So there's a trade-off. So talk to your tax accountant if you decide to make the 475 election. The nice thing about a 475 election is you can designate certain accounts for that. So if you're trading futures and securities, you can designate your securities account for a 475 election and not your futures, because you want to capture that lower tax rate for your long-term capital gains, which is 60% long-term and 40% short-term on 1256 contracts. General partner profit allocation. What is this? What is carried interest? It basically relates to carry interest. Carry interest occurs when the general partner receives a profit allocation of an incentive fee or incentive allocation from the fund they are managing. In the past, the profit allocation represents long and short-term capital gains instead of ordinary income, is what will occur if the general partner was charging an incentive fee. That's why if you're investing in a fund, you see this profit allocation to these general partners, is because they can capture the long-term capital rates on majority of their trading if it's long-term. It flows through. With the past, as long as you held a position for 1 year, you're getting the advantage of that long-term capital gain rate. Now with the carried interest rule is that you no longer get that unless you hold that position for 3 years. So these big hedge fund managers, that was one of their deals, to save on taxes, to hold that position. Now, how are we going to hold that position for 3 years versus 1? It's a big deal. So they kind of got screwed on that. And if they sell that position early, then it becomes a short-term capital gain, even if it's in year 2. So in closing, there's 20 or so different areas affected by the new tax law. And we touched on a couple that I thought would relate to our audience. But other than that, file your taxes by the 15th and life is good. Thank you.